7 companies, over 33% of the entire S&P 500. And right now, they're not all moving in the same direction. In 2026, the Magnificent Seven has split into winners, laggards, and one wild card that could either make you rich or burn you. Today, we're going through every single one. The numbers, the valuation, the YTD performance, and at the end, I'm picking just one that I'd bet on for the long term if I had to choose. Stay with me. Let's get into it. First, a quick reminder of who we're talking about. The Magnificent Seven are Nvidia, Alphabet, Apple, Microsoft, Amazon, Meta, and Tesla. Together they hold a combined market cap north of $20 trillion, and they account for a third of the S&P 500's entire weight. That means when these 7 move, the whole market feels it. In 2025, the group rose 25% as a whole, but that was almost entirely carried by Alphabet, up 65% and Nvidia up 39%. The rest? Mostly underperformed. Now in 2026, the picture has flipped again. Let's go stock by stock. Let's start with the biggest company in the world right now, Nvidia. At a $4.6 trillion market cap, Nvidia is literally in a class by itself. It got there by being the backbone of the entire AI revolution. Its GPU's power basically every major AI model being trained on the planet. The trailing PE sits around 55 times, which sounds expensive. But here's the thing, on a forward PE basis, it's only about 22 times. Analysts describe that as the cheapest forward multiple since the AI rally began in 2023. Its 52-week range tells the story, from $110 all the way to $217. Volatility comes with the territory. YTD in 2026, roughly flat. After a $4+ trillion run-up, the stock is digesting gains. Its next major earnings catalyst, the Rubin chip platform, is expected to ship in the second half of 2026. Let's move to Alphabet now. Alphabet is the quiet overachiever of this group. It rose 65% in 2025, the best in the Mag 7, and it's up another 5.8% in 2026 so far. Why? Because after years of being written off as vulnerable to AI disruption of Google search, it turned the narrative on its head. Gemini is now a leading AI model. Google Cloud is growing at over 28% year over year, and its TPU chips are emerging as a real alternative to Nvidia in the data center market. The forward PE is around 21 times, actually cheaper than the S&P 500 overall. That's unusual for a company growing at this rate. Apple, the world's most recognizable brand, and just this week it reported a blowout quarter, EPS of $2.01, revenue of $111 billion, beating on both lines. CEO Tim Cook cited extraordinary demand for the iPhone 17 lineup. The stock jumped over 3% on the news, but zoom out, and there's a tension here. Apple's PE is around 31 times trailing and 31 times forward, meaning the market is paying a premium for stability, not growth. Apple has been criticized for being late to the AI spending cycle. It's not building massive data centers. It's not dropping $100+ billion in capex. It's playing a different game, embedding AI quietly into its existing ecosystem. That makes it a lower risk, lower upside play compared to its peers. Now here's the name that might surprise you. Microsoft is down 14.1% year to date in 2026. That makes it the worst performing Mag 7 stock so far this year. But before you write it off, this might actually be the opportunity. Why did it fall? Heavy AI capital expenditure. Microsoft is spending $100 billion on infrastructure in 2026 alone. That crushed free cash flow and spooked the market. But here's the flip side. 90% of Fortune 500 companies are now using Microsoft Copilot. Azure cloud revenue is growing rapidly, and the company has a $625 billion commercial backlog. Some analysts are calling this a rare buy the dip moment on one of the most fundamentally sound businesses on earth. Its trailing PE of 35 times is now at decade low levels relative to its historical premium. The next Mag 7 stock is Amazon, which is the best performing Mag 7 stock in 2026, up 14.4% year to date. And the story is surprisingly simple. AWS is on fire. Cloud revenue grew 28% year over year last quarter, the fastest pace in 15 quarters. AI revenue from cloud services alone has crossed $15 billion annually. On top of that, Amazon is deploying robotics across its fulfillment centers, targeting up to 75% automation, with Morgan Stanley projecting $2 to $4 billion in annual cost savings by 2027. It trades at a forward PE of around 34 times, reasonable for a company accelerating across cloud, AI, advertising, and logistics simultaneously. Analysts have slapped a strong buy rating on it, with a consensus target of around $295. Meta is a fascinating split story. Revenue grew 33% year over year last quarter. Ad impressions up 19%. The core business is crushing it. But the stock is roughly flat in 2026 because Zuckerberg raised CapEx guidance again to between $125 and $145 billion for the year. Investors are nervous about when all that AI spending turns into profit. Based on forward cash flow, Meta is actually the cheapest stock in the Magnificent Seven. At 10.8 times estimated forward cash flow, it's a bargain if you trust the AI investment thesis. The 52-week range tells you everything. $520 on the low end to $796 on the high. High reward, but you need patience. And then there's Tesla, down 11.7% in 2026, trailing PE north of 400 times. The most expensive stock in the group by a huge margin, Tesla made a major strategic pivot in early 2026. Elon Musk announced discontinuing the Model S and X to double down on robotics and the Optimus humanoid robot. That's a long-term bet, not a near-term earnings story. EV competition is intensifying globally. Margins are under pressure. And at 400 times earnings, the stock is priced for absolute perfection, plus a lot of things that haven't happened yet. Tesla is a vision play. If you believe in the robotics future, maybe, but for long-term value, it's hard to justify this price. All right, you've been patient. Here's the question you came for. If I had to pick just one of these 7 stocks for the next 5 to 10 years, which one? I'm going with Microsoft. Here's my case. First, valuation. Microsoft is trading at decade-low valuations relative to its historical premium. Down 14% this year, the market has handed you a discount on one of the most durable businesses ever built. Second, the moat is enormous. Windows, Azure, Office 365, LinkedIn, Xbox, GitHub, OpenAI partnership. These aren't just products, they're infrastructure that 90% plus of the global enterprise depends on. Third, AI monetization is already happening. Copilot is embedded across Microsoft 365 and Azure. Agentic AI adoption is accelerating. The CapEx spending that's hurting the stock short term is building the long-term engine. Fourth, it pays a dividend. Unlike most of its Mag 7 peers, Microsoft returns cash to shareholders consistently. That's a cushion during volatile years. The risk? If AI monetization disappoints or CapEx keeps rising without revenue to match, the pain continues. But over a 5 to 10 year horizon, I'm betting that Azure becomes the dominant AI cloud platform. And Microsoft collects a toll on every dollar of enterprise AI spend. Honorable mentions. Alphabet at 21 times forward. PE is arguably the better value pick today. And Amazon's AWS acceleration makes it a strong case for pure growth. But for one pick for the long term, Microsoft, bought at a discount, is hard to beat. And that's the full breakdown, all 7 stocks, the numbers, and my pick. Remember, this is not financial advice. These are 7 of the most powerful companies on the planet, and there's no truly wrong choice in this group over a long enough time horizon. But if you had to pick one, I'm going Microsoft. Drop your pick in the comments. I want to know which one you'd choose. If you found this useful, hit subscribe. We break down markets, companies, and investing ideas every week. See you in the next one.